Welcome back, everybody, to another episode of Built to Scale. And I have my longtime guest with me here, Layton Johns, that he is a regular feature here on Built to Scale. So thank you again for being here, Layton. But we are actually doing a trifecta series here today where we have a good friend named Jacob Wood here that Jacob is a partner, a newly minted partner at
Minted.
Capstan. Yes, minted. And Capstan focuses on specialty tax incentives. And today we're going to dive in on the R&D tax credit expense and the revisions under the Trump or the big beautiful bill and how it applies to R&D credits, tax expense, et cetera. And so really excited to have both Layton and Jacob here and that we can really deep dive into this. So thank you for being with us, guys.
Yeah. Great to see you, Mason.
I'm super disappointed that I didn't hear the Trump impression when you said "big beautiful bill" just now.
Huge, right?
It's incredible.
Yes. Next time
Biggest
I'll
bill you've ever seen. It's beautiful.
yes. Next time I'll put little bit more orange figment here, and then I'll put a wig and everything.
Yeah.
We got to do that one time. That'd be just hilarious if we did that. Right? That did a whole session on it.
I'm sure you could do a face meld or something. You know what I mean? There's got to be an effect on this Riverside thing.
There's got to be a filter that you can do.
Trump
the
mode.
Trump filter.
Just everything shouting. It's like one long run-on sentence. Yeah, just converts it. No punctuation. Anyway.
Great stuff. Yeah. Oh yeah. Jacob, he's a great guy, doing a great job over there. Yeah.
Thank
you. Awesome. Well, so just gonna dive in here for our audience that, definitely, Jacob, this, is not a whole lot of fluff. You were on one of our previous podcasts, but not a whole lot of fluff. We like to dig into the nitty gritty and, these are even questions that I have as to its application. So I'm hoping that you can help provide some clarity even to myself here. So R&D, and this is one of these concepts that a lot of construction businesses think, wait, I'm not like a, medical company. I'm not making drugs. I'm not pharmaceutical. Like, I have R&D? What is this? So kind of walk us through real quick, a little rundown on R&D expenditures and especially how they were treated from a tax code perspective prior to the big beautiful bill. And even I know that there was just like a window in there for a little bit of a couple of years. So yeah, walk us through before the big beautiful bill. Got signed to law July 4th this year. Walk us through R&D expenditures. What makes them up? How are they treated?
I just going back, really into the 1950s, actually, that's how far we're going back here. The income tax, people think of it as this long-standing thing. It's really only been around for about 100 years. At the end of World War I, they instituted an income tax. And so there was all these questions for 30, 40 years on like, who gets to deduct what? Like, what's a business expense? And so in the 50s, they codified in section 174 that if you're doing research and experimentation, you get to either deduct that or you can amortize it. So you can treat your business expenses like that are R&D, like an asset that you have to depreciate because you're building something you're going to use in the future, right? That's like any depreciable asset, or you can immediately expense them, and they codified that. Then in the 1980s, they enacted the R&D tax credit, which was built out of section 174, right? So what happened was essentially, and I've actually got a couple of slides here if you want me to.
Yeah, please do
real
share.
quick, because I think there's some good visuals. Although if you're looking at home, you don't have to. I can explain kind of what we're looking at here. But essentially, with Section 174, when they passed the Tax Cuts and Jobs Act, they were trying to make the bill look like it kind of cost less, and so they built in this kind of penalty on the back 5 years of it. So from 2017 to 2022, under the Tax Cuts and Jobs Act, everything was the same with R&D and with Section 174. 2022 and beyond, what they said was that, for the past 50, 60 years, you've been able to expense research expenses, right? But what you have to do now is you actually have to amortize them. You don't have the option to expense them. So what this did essentially is, on paper, the bill cost less. And so, they kind of said, hey, what we're gonna do is kick this can down the road in 2021 or 2022. We're just gonna say, hey, we're gonna move this into the future. The problem was the administration did not win a second term. And so all of a sudden the administration priorities changed. And so we kind of got stuck with this rule that nobody really intended to be going on into the future, which is you cannot deduct your R&E expenses, you have to amortize them. So where the R&D credit kind of came into this is if you have 174 expenses, you pretty much have section 41 expenses and vice versa, because section 41 is basically, with the R&D credit, is a subsection of section 174. And so if you were claiming the R&D credit, people, all of a sudden you had this 174 issue where you had this income that you could no longer deduct. So let's say you're a construction firm and you've got $1 million of engineering payroll. These people are doing like maybe mechanical design, right? And then you do you perform the work and maybe you do some GC work too. All of a sudden, instead of deducting that $1 million in wages, you had to amortize it because it was a developmental expense. And so that spikes your income tax rates over that 5-year amortization period until you get to year 3 or 4 or 5, where all of a sudden you've got the same amortization as you've got built up over those 5 years. And so, this is obviously very unpopular and, essentially penalized companies that were doing technical development. And so this kind of caused a lot of companies to say, hey, I don't know how much R&D we're really doing, or, they didn't want to claim it because it was shining a spotlight on their section 174 expenses, which they had to amortize. So that's kind of the overall of the landscape. So tax years 2022 through 2024, there was this window where you had to amortize your research expenses and basically get penalized for doing technical development. And then, so essentially what happened is that the new administration came back in, they were able to then fix this rule, which they had intended to do years earlier, and fix this in the big, beautiful bill, or the OB3, or whatever we want to call it.
Got it. Walk me through, because, it's one thing, an expense, on an income statement to me, and on, income tax report, I treat it like a deduction, right? But then we're talking about the R&D tax credit, different than the deduction. Like, walk us through the differences of those.
Yeah, absolutely. So there are some differences. So the 174 was the original deduction, which became a mandatory amortization, as it's called. And that's really anything that you do that's experimental. So there's not a lot of tests to it. It's kind of like a something that would be on like a GL account. It's like basically it's like overhead, rent, any expense you make that goes into some kind of technical development, whether that's an engineered design or a new building or a new product or a new methodology. Section 41 is much more refined. It's much more targeted. It is a dollar for dollar credit for certain activities and certain expenses. Those expenses are generally either going to be somebody's wages, they're going to be a third party contractor that's doing research on your behalf. It's going to be rental or lease of computers, which is like a kind of a nuanced category, but it's a special one. And then there's supplies or materials. And so for most companies, wages make up like 90% of their R&D credit, unless you're maybe like a heavy manufacturer or something. Maybe you have some third-party contractors, but for the most part, it's wages, and it's very targeted towards technical development activities. So in kind of a construction engineering architecture kind of standpoint, we sometimes call it AEC, right? Architecture, engineering, construction. You're really talking about like the design development, or perhaps maybe some constructability or construction feasibility concerns. And it's your problem solving that goes into that. You get a percentage of those expenses back in the form of a credit. So if you had like $1 million in engineering payroll at your construction company for constructability, construction engineering, and like maybe some design work, you might get something like a $50,000 to $100,000 federal credit for that $1 million in technical payroll.
Got it. Got it. So really, for the credit, it's a subset. I mean, your graph shows it here. I just needed to be walked through it too, but it's really a subset of this whole section 174. Like, there's qualified expenditures that also are within the category of 174, but that actually fit this little, tax credit qualification.
Yeah, section 174 is just a little bit broader than section 41. But again, the whole reason people, we're talking about this is that, for years and years, you could deduct your 174 expenses. And so essentially what happened with people is all of a sudden they're sitting there and they're getting their R&D credit and they were, going along smoothly. Well, all of a sudden, from an accounting standpoint, they had to start amortizing a certain amount of their expenses. And so again, that not only spiked income rates, but also if you were a company with high income but low margins, so you spent a lot of money on R&D, but you kind of had a low razor thin margin, you essentially had a liquidity crisis because all of a sudden it looked like you were making more income than you were because you had to defer those expenses into the future. And a lot of smaller firms and startups, like very technology heavy companies, face this issue. Now, I will actually say a lot of construction companies and design build companies that we worked with, this was a little bit of a lower impact on them because while the bill was high, a lot of these companies have high margins. And so they were able to pay the tax and kind of move on. For them, there's actually some different opportunities, which we can talk about in a few minutes. But if you were able to pay the tax bill relatively easy, it was a setback, but it was not detrimental to your overall business model.
Got it. Got it. Okay. I appreciate too, because you kind of lumped in there too, like for a construction company, what are the qualified expenses? So that was really good because that was going to be a question I want to make sure that we covered that, we're talking about
Certainly.
this, but how does it actually apply to construction businesses, right? What should they be thinking about? And
Definitely.
it's really that design work, that engineering work, if they have that in-house. I real quick question, and this is again for our audience. I hate to, we go detailed here, but we also like to not make assumptions. And I know that you and I have worked through this, but say you have a design build contractor, they don't actually have the engineers or the design team on staff. Is there much there that can qualify for, the R&D tax credit if they actually don't have that payroll on staff? And if so, how would they qualify for it?
Absolutely. Yeah. I mean, typically, what the main activity from a construction company that you want to qualify is that technical development, which normally means you have to have an in-house design or engineering group at your company. Now, the exceptions to that are if you put a tremendous amount of thought process into maybe like constructability. So we've had like crane engineering companies where it's all basically process of how you're going to move stuff, but the cranes themselves are so heavy that there's actually kind of engineering there. They're not designing anything. They're literally just talking about constructability, but they have to do some kind of development. So I would think of it, certainly the easiest way is if you have like an engineering design department, you're going to have some qualified activity. But the other way to think about it is, do you have payroll that's all that they do is doing some kind of technical development where you have feedback loops? So I mentioned the term feedback loops, and what I mean by that is you go out and you have to do some kind of analysis, and then you have to do kind of a scientific method where you come back and reassess and maybe change your analysis. So for example, crane engineering, I mean, you get these super, super heavy cranes, you have to figure out where they're going to go. Again, you're not designing the building, but you have to do structural engineering for the streetscape to even put a crane there. I've had projects where you put a crane to build a crane on a building that's going to then build the building. And that just, like, you think about the sequencing and the engineering that goes into being able to do that. And there's a lot of things like that, right? There's soil engineering, geotechnical testing, and kind of modification or rehabilitation that goes on. So there are some other areas, but you really have to have kind of a repeatable technical process and those feedback loops where you're getting information and assessing and reevaluating. That's what's going to ultimately qualify a company. There could also be, we do see this at some of the larger construction firms, maybe some software. If you're creating some bolt-on software that's going to go onto like Procore or something like that, there could be some technical development at a certain size and scale. Just about any company is going to have R&D because you're going to start bringing things that you had out of the firm in-house, and you're going to be taking on those problems. So we've even had like a bank is a good example where a bank at a certain point becomes a technology company because it just is so big. And there's a similar corollary with a construction firm.
Got it. No, it makes sense. That was good. That was a great explanation. And so yeah, you have the slide up. I really want to understand what are the changes in the big bill going forward. If I could kind of summarize, my understanding so far that, the past couple of years that Section 174 of the tax code made it so that companies had to capitalize and then amortize their R&D expenses or expenditures, I should say. And a lot of companies didn't want to take advantage of even the R&D tax credit because they would, like you said, it would put a spotlight on, what are potentially other 174 things here in the event of an audit. And, so for those that were just kind of, not even bringing them up and just stuffing them into their income tax returns, doesn't sound
A lot
like
of
they
head in the
maybe,
sand.
yeah, a
A
lot
lot
of
of
headless
ostrich
sand.
approaches. Yeah.
Yeah, it's just an expense. Like it's just a normal expense, right? And it's just
Sure.
payroll, right? And so companies were trying to navigate, still trying to not pay extra taxes, because if they made sure that they codified those things appropriately as Section 174, it would have
Sure.
effectively added
It would have
income on
affected
each
their
year, right?
tax. Yeah.
Yeah, it would have affected income tax every year, would have added more taxable income, and nobody wants to do that. And so
That's right.
I Big Beautiful Bill changed that though. So walk us through some of those changes.
Yep, absolutely. And I know if you're not watching this on YouTube, there's a dog blowing a birthday. What is that, like a birthday kazoo or whatever that is, with a birthday hat on. So if you didn't, get on YouTube if you're listening to this. But yeah, the headline here is basically that that mandatory amortization is essentially no more. So tax years 2025. Now the IRS did not do this, or Congress did not do this in a simple way. So there is some nuance still, as there always is. But 2025 and forward, you do not have to amortize anymore. So for every company, 2025 and beyond, no amortization. So this really frees companies up to be able to claim an R&D credit, but also just not have to do anything with 174. There's no special calculations. So that period that applies to is really only 2022 through 2024. Now, one thing just to note before we jump into some of the other nuances is that a lot of companies who did not amortize, and they did not claim any R&D and so on, essentially what they were doing is they were kind of taking a risk that the IRS would not audit them. Now, I did not see hardly any audits. I don't actually even know of any, because the IRS did not want to go in and audit something that was going to get fixed. And Congress kept talking about fixing this. So we were kind of in this like 36-month period where people knew this was going to get fixed, but it wasn't. And so people just didn't know what to do, right? So kind of the head in the sand. Honestly, it didn't end up being a bad strategy. I hate saying that, but it was kind of a weird time, right? They took away the amortization for domestic expenses. They actually kept a 15-year. It's not the 5-year that domestic was. It's a 15-year amortization period for foreign R&D expenses. So if you do have like a design department or a technology team overseas and they're doing something development, I do think in the future you will see a lot of audits in that, because that's a lot of income that is not being recognized. And so it is something where I think now that domestic amortization is gone, you want to be aware of your foreign dev team or designers or whatnot. I do think that if you look at the OB3, the overwhelming focus of it is bringing technical jobs in manufacturing and engineering back to the US. And so construction firms, I think honestly, a lot of those jobs are not portable because you have to be in the US to do construction in the US. But if you've got some foreign things, you do want to make sure at least you recognize those as the amortization expenses that they are.
No, that makes complete sense. I know several engineering firms that, I mean, yeah, they have a lot of their team members outsourced from the Middle East or whatever the case is. That it's just such a common practice. It's like CPA, too, right? That they get a ton done in the Philippines or South America and other things too, right? So, yeah, I don't know that it would affect contractors quite as much, but anybody else in the AEC space that, yeah, I what you just said there is so important. This only applies to domestic only. And I think that's a general theme that even on the previous episodes that Trump is generally incentivizing production properties, manufacturing coming back in the state in rural areas of the United States.
Sure.
Like
Yeah.
it's a love letter to his voter base, right? I mean,
It really is.
if I
It
could put
really
it,
is.
it is literally a love letter to his voter base. And so, if you can expect it to be a little Trumpier, this is about as Trumpy as you can get. That this doesn't apply to anything foreign on R&D, right? So,
Yeah, for sure.
yeah,
And
yep.
and I mean, it's interesting. Like even Wall Street Journal ran an article yesterday morning about how the technology job postings, because everything's AI and data driven now, so you can see like technology postings for this quarter have already matched last quarter's total job postings, and we're only 5 weeks in, 6 weeks into the quarter. So I mean, that's a doubling at least, if as long as it doesn't accelerate. I mean, it could be a doubling or tripling of the number of technology jobs that are domestic based because of these sorts of things, right? So people are going to hire, and that's the interesting thing. I think it actually will be. It seems like a very effective tax policy at doing what it intends. You could argue about whether you like some of those aspects or not, but I do think it's going to get what it wants done. Um, and one of the pieces again on the amortization, so 2025 and forward, you don't have to amortize. Now for all taxpayers, they built something that's actually pretty cool into this, which is that if you do have amortized expenses that are carrying forward, you can write all of them off in 2025 or 2026. So, I mentioned like the example construction firm that just kind of paid the bill begrudgingly, but was able to do it with cash flow. Well, all of a sudden, from a tax planning standpoint, think about this. You're getting like 3 years of deductions. Oh, but wait, it's actually 4 because that's including 2025. You're getting like 4 years worth of deductions written off in 1 year. So Mason, I mean, for your team, you're thinking about this from like a cash flow, liquidity, like that's a lot of money to pay people more, to build a facility, to take more projects on. I mean, if you are somebody that has R&D expenses and you had to go through this amortization, you're going to get a huge write-off in 2025 because you have the option to write off any remaining amortization 2025, 2025, or 2026, or you can just write it off over the 5-year amortization period that you already had. So that pretty much mitigates, you catch up on that amortization, and those years are going to be really good from a tax flow standpoint.
Yeah,
this is.
Go ahead, Layton.
This is really exciting to me because anytime that there's a new tax bill that comes out, there's opportunity for change and to take advantage of things that are new. And I think that a lot of people, they don't really think about tax planning from year in and year out, and they don't notice that they may have these new opportunities that are available to them. And with the new laws, the government's always trying to get you to do something that they want you to do. And in this case, like Mason said, it's investment in manufacturing, domestic manufacturing within the United States. And there are nuances that are now available that if you don't go and consult with someone like yourself or your CPA on what is available to you, you may end up, having sorry, kind of lost my train of thought there.
Yeah, you can miss it. You can miss it. And actually, that I've got another slide here in a second, which I'll show. But actually, if you are a small and mid-sized business, so they define that under Section 448C as a business under 31 million in average gross receipts. For those companies, they actually retroactively repealed the amortization for 2022 through 2024. So if you're a really big company, $70 million of gross receipts, you still have to amortize, but you can catch up in 25 and you can basically be made whole. If you're a small and medium-sized business with under 31 million in average gross receipts over that 22 through 24 period, then you can actually retroactively get rid of the amortization, which means if you claimed it, you can go back and get those taxes back, or you can claim it now without having to worry about the amortization. Now, Layton, to your point though, this is time sensitive because you have to make that election to opt out of the amortization within 1 year of the OB3 enactment. So you basically have until July 3rd, 2026, if you want to do that. You can always go back and amend and claim the amortization, but you have 1 year to basically, if you want to go back and amend and either claim it for the first time, claim R&D, or get your taxes back, you have 1 year to do that.
So to your point, there is a very time sensitive piece to this in that 2025 is a big year to make some significant tax changes, the way your business operates, and it is time to go consult with somebody.
Yep. And there's some nuances about whether you want to amend or not. I did want to show a couple of pages, just the impact of this on businesses. So if you see, and again, if you're just listening, you can't see this, but I'll describe it. So we've got basically what is the marginal impact of amortization, and every taxpayer is like a little different. So we tried to kind of control as much as we could. So we assume this is let's say California-based design build construction firm. With about $1 million of R&D expenses, which because Section 174 is a little broader, you got about $1.25 million of 174 expenses, and you're going to get $100,000 federal credit and a $50,000 state credit per year. So for that sort of a taxpayer, what would be the marginal impact year by year of claiming an R&D credit, but also recognizing those expenses? And you can see if you're looking at this, 2021, you end up with basically lowering your taxes. You engage in an R&D study, you claim the credit, you recognize the expenses, but there wasn't amortization, so you were fine, right? Once you get into that amortization year in 2022, all of a sudden, even though you're getting a $150,000 credit, you're paying $250,000 in more tax. And you can see 2022 through 2024, as you stack those amortized amounts, the marginal impact goes down. But with this new tax law, 2025, all of a sudden, you not only get back all the taxes you paid, but now you've basically gotten the credit as well. So you have a $1.1 million tax savings in that year. And then on a go forward, you're back to saving taxes. And we've got that same example on the next page, the cumulative impact. So this is the marginal impact. The cumulative impact of that pass-through entity with federal and state credits. The first year, you're saving about $113,000. And then you're basically on a multi-year plan, your net, all of a sudden you've paid 150, you get to about $410,000 of out-of-pocket taxes you've paid cumulatively. So you can see how then in tax year 2025 through 2029, all of a sudden you recognize these expenses again, you lower your tax bill, and you're saving money. So this is basically what is the cumulative impact of this situation. And then we also have, I'll show them, but I won't go into them too much. If it's a C Corp, C Corps pay a little lower tax rate. So the payoffs are a little bit better and a little bit faster. But you can see what the impact of that OB3 tax bill impact is in 2025. I mean, if you're sitting there and all of a sudden you're getting $700,000 back off of your taxes, that's a lot of money to play with.
100%. That I just, man, like the combination of the effects of all these things, whether it be this change timed with, 100% bonus depreciation on qualified production property, as well as just other provisions of the tax bill. I just like it just feels like it's just like such a compounding effect over just a couple of years. It's like trying to light a fire on it. It's just so fast.
It is. It's a shot in the arm. I mean, in a lot of these, I know you guys talked about like QPP. So we do a lot of real estate incentives, cost segregation, 179D energy deductions. There's a real window here. There's like a 5-year window. If you're going to build a facility or you're going to do something, I mean, some of these things are permanent, although I kind of joke they're permanent for now because you never know, 4 or 5 years, next administration could it's a coconut shell game of moving things around. But I mean, you've got a 5-year window here where manufacturers, engineers, design build constructors, software developers are going to have a lot of tax savings, and it's really the time to plan. But the thing we keep saying is you really have to plan with somebody that knows what they're doing. So I mean, I know Brady, CFO, you guys are on top of all this. For those of you who don't know, Mason's pinging me all the time on my phone about what's the update on something, which actually we love. Because I'd rather have a plan than do something post facto, right? But
Yep.
I mean, that's where you have to be with this, because if you try to plan for this in 2027, the lead times in these projects, you're not going to get your building in service. You're going to miss the election windows. So it really is important to do it up front.
So I know something that Mason and I talked about on a previous episode was that the way some of the qualified production property and the benefits of putting those into service are going to come into play, that manufacturing is going to be a big sector. Within R&D, do you have any sectors in mind that contractors should be targeting in terms of who they're marketing to that may benefit to where they're needing to go build these types of facilities?
Oh yeah. I mean, the manufacturing, I think, is the biggest one. Any industrial space. I mean, there's going to be, in my opinion, there's going to be billions and billions of dollars going to funds to build these facilities. So like if I were a construction firm working on anything industrial manufacturing or any spaces like that, I mean, start breaking ground, because there's going to be spec industrial facilities going up left and right. And it's going to be because there's going to be a lot of money flowing into that. You're going to have, diversified international manufacturers that are going to basically want to sell, because remember, you've also got all these tariffs. So these tariffs, you basically have a carrot domestically and you have a stick foreign. So I mean, like if you're a BMW, I know they have facilities in the US that sell to the US, but they're going to like triple those because there's no way if they can build $100 million facility and write the whole thing off in year one, their costs are almost nothing. But on the other hand, if they build something in Germany and ship it over, they're paying a 30-40% tariff on that. It's like a 7-to-1 cost ratio. And so if you're a construction firm and you're like, hey, let's go build some stuff, you want to start breaking ground now because the time limit on these things, the facilities have to be in service by 2031. And they have to break ground by 2029. So, you want to be getting permits. The money will come if you've got a facility, and, domestic people are going to be putting money into their facilities. Funds are going to be popping up, and the diversified kind of international manufacturers are going to be doing more domestic manufacturing for the domestic market.
Yep.
So
I liked
for
how
contractors who have
oh,
never taken any kind of R&D credit, is it worth amending and looking back the past few years?
It can be. Typically, it probably depends on how many shareholders and such. If you got like a one entity C corp, I mean, it only needs to be a $30,000 or $40,000 per year credit to make that viable. If you got like 20 members of an S corp, you got to amend the S corp and then all the individuals. So the dollar amounts have to be a little more. But I would say for anybody, explore it, because at the very least, like when we go through, we don't charge anything for an estimate. We'll give you advice. We'll say, hey, sometimes we talk to people and we say, hey, you're close, but you don't quite have the activities. And I know, Mason, we've talked about this with some of your clients, but we at least give them the criteria where, hey, if you bring this in-house, it's going to get subsidized. So a lot of times it's bringing in a design department, because there's a lot of contractors that just do, performance work, but maybe they kind of get involved in design assist. Well, if they want to bring that in-house, there might be a 10 or 15% subsidy. In California, if you get the maximum federal and California credit, it's a 20% subsidy on every dollar you spend on technical payroll. And so that's a huge amount back. And so, why not bring 3 employees in-house and, own that piece of the process, right?
I think I like what you mentioned there too, that it's the combination of all these things. Like I think sometimes, and it doesn't matter whether you voted for this administration or not. I just think sometimes we can view things within a very, isolated lens, and a lot of people don't understand this tax bill. But the combination of the tariffs with this tax bill, and now it makes you think like why Trump's so mad at Jerome Powell for not lowering interest rates, because all of a sudden if he did that, it'd be like the trifecta in regards to
Sure.
it'd be
Exactly.
like, oh, just put gasoline on it at that point in regards to what we're trying to do here. But it's the fact that the combination of these things. I mean, I still look at it like there are some big gambles being made here, right? Like we don't have, proven. Sorry, y'all. Jacob just had some technical difficulties, so we'll try to get him back in here. But I'll kind of keep running with this of just the thought.
Hey, I'm
so
here.
it looks like perfect. Jacob's coming back in. Okay, we got you on record.
Yeah,
We're
sorry,
good.
just kicked me out for a second, so I don't know what was going on.
Yeah, that was weird. I never had that. So sorry to our audience, but yeah, we'll
Kicked
kind of
me
keep
out.
rolling here.
Too much.
We'll keep it rolling here. Yeah. It's way too huge.
Yeah,
No,
exactly. It was like,
yeah. Yeah. Maybe the internet didn't like us talking political talk and decided to
yeah,
kick
who
us
knows?
out
It's
or
the
what.
AI algorithms.
Yeah.
But Mason, I mean, to your point, I think in particularly in the political process, I think people don't understand what you're really talking about is so I studied economics undergrad, and like the externalities. So people think on like linear, like one variable analysis where they're like, taxes are good or bad. And it's like, well, it's not really that. It's taxes combined with other policies can be good or bad. And so that's what you're seeing the confluence of multiple policies lining up. In a way, I don't think the Tax Cuts and Jobs Act was quite as coherent. And again, you can disagree with some of the thrust of this, but it is a somewhat coherent tax policy, at least from an incentives. It's easy to understand from an incentive standpoint. If I'm a manufacturer or if I'm a construction firm, I want to get into R&D, I want to get into manufacturing, right? That's the incentive that we're hearing in the marketplace.
Yep, very much so. So thank you, Jacob. That want to kind of wrap up here. You've given, I mean, I have a list of questions off to the side here, and you've covered them all on your own pretty well here. So thank you for that, and thank you for the slides too. You're our first guest here that has brought slides. Although,
I
Layton,
blame our marketing department is awesome. So Shout out to Helena.
Yes. Fair enough. My only previous guest has been Layton, so I can't give him too much of a hard time.
Well, you got a deer head in the background. I don't have that. I need to. Yeah. I'm gonna get like a rhino head or something.
Fair enough. But walk us through, because the final piece here is, like you said, there's planning required for this, right? And just like there's planning for the projects and placing things in service, it's not like, taking advantage of, say, an R&D tax credit is just marking a box on your income tax return. Like, it's not that easy. So kind of for our audience that has never gone through, and gotten an R&D tax credit before, walk us through the process that's required. Like, where would your team come in and help them?
Mm-hmm. Yeah, absolutely. So, I mean, first of all, it doesn't take that much time to do some due diligence and assess, right? But we're really looking for two things. Number one is we're looking for qualified activities, right? And typically we'll say projects, but that's really, what are your design or development or innovation or invention kind of efforts, right? Maybe you developed a new piece of equipment, or you do customized designs, or you have new software, something like that. So we're looking for what those projects and activities are. So typically we have a quick discussion. We say, hey, what are the innovative things you guys worked on? Where do you guys solve problems that are technical in nature? And we talk through that. The second piece of it is looking at the expenses. So we'll gather some financials, we'll gather some W-2s, some things like that. And then we'll be able to tell within, a 30-minute conversation and a couple of hours of reviewing documents, whether you have a viable opportunity. From there, we just do basically that same process, but at a more deep dive level. We're looking at a list of projects. We're doing interviews with technical SMEs, and, we're verifying things. There are some nuances to the forms and the filings, but we typically would work with the CPA and the CFO at the company to make sure that stuff gets filed. If there's amendments, we help do the pro formas and such. So mostly what companies have to do is, make some of their people available for interviews, send us documentation. It's not too invasive of a process. And like I said, we typically can tell fairly quickly whether it makes sense to do an analysis or not. And if not, we will give you some rules where, in the future, if you have those activities or expenses, then you can qualify in the future.
Got it. Makes sense. And I think for most of our audience, if you have not been through this process before, so Jacob works at Capstan, which is a firm that specializes a lot in these specialty tax incentives. And, say for a lot of our clients and whoever might be listening, like, you might be working with a very localized, CPA firm that doesn't have the bench to do everything that Jacob's team can, right? And these specialized tax incentives, they require this analysis, require a bit more robust work. And so it just, keep that in mind that, this is not something, okay, I go talk to my local CPA and they're going to do this for me. That they may offer the service, they may, but yeah, if you need help, I definitely encourage our audience to reach out to Jacob. And if anybody wants to reach out to us, we're happy to provide his contact information. But Jacob, where can people find out a little bit more about you and Capstan?
Yeah, absolutely. So, I mean, you can visit our website, capstantax.com, Capstan Tax Strategies. I'm also on LinkedIn. It's Jacob P. Wood, and I've got a dashing smile and a sense of humor. So
there you go.
Yeah, there you go.
That's how you make partner, right? That's how you make partner. That's how you make partner, right?
That is how you make partner. You know how you make partner? Make partner level decisions.
Yes. No, just the dashing smile, I thought was it. So.
That and a couple of days. It is amazing with I love working with CPAs, but it's a fairly low bar. Like, CPAs don't like public speaking. So if you can get up and tell a couple of dad jokes, like, people love it. And
you said it, not me.
You get to be a rock star. If I went to like a comedian convention, they'd be like, this guy stinks. But like,
you said it, not us. So thank you.
That's all right. We love our CPAs.
Yes. Awesome. Well, thank you, Jacob. Really appreciate you that. Just even appreciate just the work of bringing on some of those slides that really encourage for anybody listening. If you listen to this solely on audio, it would be worth checking this out on YouTube, that this is a video-based podcast. And although we distribute this in audio form, please come back and check this out on YouTube so that you can actually see some of Jacob's slides. And this is something that every construction company should be looking at, that especially if they're involved in the engineering or design work in any degree, if they're outsourcing it, considering, hey, how do I insource it? But just making sure you're taking advantage of this. So thank you, Jacob. Really appreciate having you on, brother.
Absolutely. Great to see you guys.
Awesome. Thanks. Hi, everyone. So if you enjoyed today's episode, and you found value, or it raised some questions for you about the next best steps for managing your finances in your construction business, please reach out to us at bradycfo.com. There's a contact page there where you can fill out, and that will come straight over to us. Either that, or you can personally find me on LinkedIn. My name is Mason Brady, and feel free to send me a message, and happy to chat and talk through anything you're facing today, and happy to provide some advice. So thank you all. Appreciate it.